Yeah, very good afternoon to one and all present over here. Today's speaker, C. Ankit Maheshwari ji from Jaipur and Kuldeep Kothari ji. So today we are gathered here on this virtual webinar on the series Grow Your Practice. So very good afternoon to all the professional colleagues participating in today's webinar. It's our fifth program continuously on every Friday. We hold Grow Your series, and this is the fifth program. And we try to upskill the knowledge and the skill development which a professional need in their routine practice in their practical life while certification doing audit work. And definitely this particular events relate to the committee members in practice, and I am happy and I am fortunate to receive as the chairmanship of this very important committee in terms of members in practice are concerned. Let me share certain initiatives which we are going to do in time to come. And one of the very important initiative which we have taken in this, that on from 3rd May to 5th May, a 3 days practice ki Pathshala program is going to be organized in Center of Excellences of the Institute, both at Hyderabad and Jaipur, where we will not only be discussing the academic part, but we will be discussing the technical and the growth part, networking part, and ethical part, statutory part, which will upscale us. We'll be discussing about the various professional opportunities which are relevant in today's environment, because in most of the cases we are focusing on audit work. But friends, let me tell you, when we study and we deep dive into the market capital of our profession, we understand that only 10% of the total business in the profession comes from the audit fees. Rest 90% of the business comes from the non-audit fees. So again, that becomes very relevant, and the assurance services, the consulting services, the reporting aspects are another source of real business for all of us. In the same line, we'll be doing the practice key Udan for the newly qualified certificate of practice holder in every state, where we'll be inviting last 5 years qualified chartered accountant to make them understand what the profession is all about, and to provide a hand holding to these qualified chartered accountant so that they can upskill themselves and grow further in the profession. We are doing various tie-ups with the various corporates, and I assure the CMP benefit site is there where you can find all the tie-ups done with the institute. Also, if any member feels that they are connected to any of the organization or any of the company which can come on board at the institute platform to provide services to the institute, we are coming with the various technological aspects. And this year the institute has formed the very important committee, that AI in ICAI, when the ministry in the central government is also planning to conduct some board or committee on the artificial intelligence. At the same time, institute is far ahead and has already created AI and ICAI, which aims to develop its own GPTs in terms of whatever the journals are there, whatever the case laws are there. And in fact, we are going with the study materials for the students, and we are into the preparation. And maybe in couple of months, we'll be able to see that different types of GPTs for different types of product will be available. And we are taking various other another initiatives. So in lines, we today our session is unveiling the challenges and solution in accurate disclosure and capacity building. And with the eminent speakers Ankit ji and Kuldeep ji, I'm sure that we all will understand the important aspect in terms of providing the assurance services, because we can see the NEFRA, the company, ROC, MCA, even the institute is continuously focusing in terms of we are doing the peer review, we are doing the AQMM audit quality maturity model, then we have the TAQRB, which studies the tax audit reports of the various listed entities. And in terms, we want to improvise ourselves and to understand that what kind of challenges and what kind of understanding we need to have while performing our audit and a test function. So with this, I conclude and I congratulate. And of course, I would further add that if any kind of suggestions are there amongst the members, feel free to connect anytime. We'll discuss on it and we'll try to incorporate these suggestions in time. And if certainly required, we'll bring these agendas in the committee for members in practice and go ahead. So thank you very much. So with this, I will request Priyanshu ji, or maybe I think Ankit ji, you can please take up the session and please start. Thank you very much.
Surely, surely. Thank you so much, Rohit for sparing time for this webinar and coming up and deliberating with all the members presenting here. My sincere thanks to you for making it happen at such a short notice. And this is the opportune time also in terms of while we have just closed the financial year, what things we should do and don't in terms of financial reporting. But friends, let me first, you know, brief you about what Rohitji has been doing in last 3.5 years of his 2.5 years of the council. We have somebody from my city only who has reached to the council at such a young age. The transformative initiatives which he has been taking since 2.5 years, it's been very visible. And and genuinely, I feel Rohitji that things have changed in your leadership, and there's a lot of scope which we personally feel that all young members, even Rohit is younger to me, but now even I have started looking up to him for all the initiatives and excellent things he has been doing with council. Amazing initiatives, I must say. Practice ki Pathshala, practice ki Udan. These are all residential programs, and I am sure that there is a lot of mentorship which a practicing chartered accountant requires in earlier years. So full marks to all the efforts which you have been doing it for council, for members at large, and we hope you keep doing that and keep energizing us in the way. Uh, in the way you have been doing. Let me also place my thanks to Vice Chairman of the committee. I have my fellow speaker, CA Dr. Kuldeep Kothari, and sorry, CA Kuldeep Kothari. I'm sorry, right? And he has been instrumental in helping various companies in adopting to the major changes of financial reporting landscape. And today, the entire thrust will be on the case studies uh, of how do you present your financial statements in a better way. How do you present your notes? And we will give a lot of thrust on the material accounting policy change. So the session flow will be that initially we will be deliberating on the material accounting policy change. When I say material accounting policy change, delve into what MC has notified and what companies have been doing in adopting these practices. And as an auditor, what you should consider while you are, attesting a financial statement, while you are providing an assurance to a financial statements. How do you look into this change from material accounting policies perspective? Then we go into the financial reporting side of it. And Kuldeep ji, my idea was that let us
Hmm.
pick one standard, one
Correct.
average disclosure, and one better disclosure. And what is the expectation from an auditor pertaining to that particular standard? Is that what we shall be looking up to? Uh, in terms of uh, if we are left with some time, Kuldeep ji, let's
Hmm.
also try to deliberate on auditors' responsibility on non-financial disclosure. We have BRSR assurance coming up, right? We have, lot of reporting frameworks which are lined with global practices. And what role the auditors play into this when a company starts publishing these frameworks. So that will be the session. And I am telling you that nothing theoretical comes out of this session. All we will do is only practical case studies, use cases, use financial statements, and what could be the best possible solution uh, to the problem which industry is facing. Kuldeep ji, before I want to
Hmm.
deliberate on this further, right?
Hmm.
As Rohit ji, rightly discussed about institutes mechanism, and I genuinely feel that the
Hmm.
this webinar was always thought in the line that as professionals, professionals from management side also, and from auditor side also, face lot of challenges while they are preparing these financial disclosures. In fact, I see so many initiatives not only from this committee, from other committees also on pertaining to financial disclosures, because this has become uh, a little pain point for profession. And I would say little pain point because there is a lot of adjudication which is being done on the matters which has been highlighted by QRB, the matters which have been highlighted by FRRB. Rohitji mentioned about the Tax Audit and Quality Review Board. And then we have a peer review mandate which is simultaneously coming up. With all these things, uh, I think we have to delve into what is happening at the ecosystem, and then we come on how do we adapt to all these changes which has been coming up. So, friends, primarily, institute has four very important boards which takes care of the quality assurance mechanism of the professionals. And we have to understand the functioning of these boards, because all these boards eventually are monitoring the quality of the financial reporting which we have been doing. And once you understand the function, then you understand the case studies which we are discussing also, that you know how a board responds to these issues. So we have at top, we had a quality review board, and and from January 2019, the quality review board is now a prerogative of NFRA, and that is why you see a lot of reports coming from NFRA side on the quality review mechanism of the auditors also. So before that, institute used to, you know, review the quality control mechanisms deployed by the audit firms based on the financial statements they were testing. So this board is playing a very vital role, and whatever prohibitions you see, whatever laws you see coming up from NFRA side, eventually this starts moving through these boards only. So a practicing unit is always subject to QRB if it is auditing some, or if it is giving an assurance to some entities which are in which public at large is already vested. So there QRBs play much more important role. Then we have a very important board which is FRRB, and in July 2002, the Financial Reporting and Review Board was constituted into 26th Council meeting of the Institute. While FRRB was constituted, FRRB now plays a very vital role in monitoring the compliance to the uh, professional standards and technical standards which Institute has formulated. And in fact, you will see in times to come, because as we have lost our QRB, so the FRRB has become more robust in figuring out, how a practicing professional or a management adheres to the accounting standards, or adheres, or the technical standards, which are the council guidelines also, which are the guidance notes also, which are the guidance which is provided by the Ministry of Corporate Affairs. For example, when we talk about, compliance to accounting standard, right? In DAS, we have Division 2, Schedule 3 to benchmark to do that. And all these guidance parallelly is provided by the institute also, and at certain stages from Ministry of Corporate Affairs also. So FRRB is putting up a lot of things. And as we delve into case studies, I'll tell you also, we will try to tell you that, these are those case studies which are pertaining to FRRB, these are those case studies which are pertaining to QRB, or the third board, which is the peer review board. And if if today a professional has to stay into practice for a longer horizon, I think it is mandatory that we get ourselves peer reviewed. And this board has taken a lot of initiatives in time, in last couple of years. We are chasing up a mandate. Yes, we are extending deadlines from auditors' point of view, but I don't think there will be any leeway. So all those practicing firms which are 5 and more partners and above now are almost on the verge of getting themselves peer reviewed. So those who have joined from practicing units, my request will be that get yourself peer reviewed, and it is high time. And the last board which Rohit also mentioned was Tax Audit and Quality Review Board, and which is again a very important board. Now, Institute is trying to build a lot of capacities in all these four boards, right? And there are empanelments open on all the four boards aspect. People want reviewer from quality review boards also. People want reviewers from FRRBs also. Institute wants reviewer from all peer review boards and tax audit and quality review board. Tax audit and quality review board is subject to assurance which we have been given in compliance to RBI, in compliance to SEBI, in compliance to CBDT, in compliance to CBIC. All these where the quality issues pertains to all these audits which are done in compliance with compliance to regulators, there there itself tax audit and quality review board plays a very important role. So from here we start our presentation. I hope the basic idea to
Mm,
tell you about
correct.
these four for that people get themselves well versed with why institute is so much giving thrust on financial disclosures. We were always expected to
Mm,
comply to the accounting standards and standards of auditing, but why now today, today itself I told you there are three webinars on different forums talking about financial disclosures, right? So I'm sure next 1.5 hours uh, will be an exciting 1.5 hours, and you will only find use case studies. We don't have texty presentations. We just have snapshots of financial statements of various listed companies. And let's together, all the people who are in the webinar, let's together try to analyze whether, from the management perspective, whether this disclosure is setting out right or not, from auditor's perspective, whether this disclosure is setting out right or not. That's what the idea is. Over to you, Kuldeep ji. In meantime, I share the presentation for the opening
correct.
remarks and then we take it forward.
Thank you, Ankit ji. Thank you, Rohit ji, and Vice Chairman of the committee for providing us this opportunity to interact with all of you. As Rohit ji has rightly mentioned, and about the initiative is the committee is taking for upliftment and upscaling of the knowledge of practitioner, and what Ankit ji has said in extension, I think both things are correlated to each other. Like often and let we discuss a lot about what a management or what a company should look into while making the financial disclosures, while implementation, while looking at the implementation of a particular Ind AS or Companies Act or SEBI, LODR, etc. But I would say that auditors, statutory auditors per se, and the companies are two sides of coin. Uh, One side is, if one side is company, then the other side is auditor, and it has to fall like on one side. It cannot be like standing in between like it happened in Sholay. सो अगर कंपनी पे कोई इशू आएगा तो अल्टीमेटली वो इज सर्टिफाइंग द ट्रू एंड फेयरनेस एंड वो इज सर्टिफाइंग दैट एवरीथिंग हैज बीन कंप्लाइड विद it is us as auditors what we are doing. So I think this whatever we will be discussing next 1.5 hour, and as Ankit has rightly said, that a lot of regulators, NAFRA specifically, and the institute's quality review mechanism being strengthened up in coming time, it is imperative for us to upscale and to have deep and detailed understanding of what a minutest mistake can do to us. So we'll be discussing from, you can say, sui se leke aeroplane tak. So from A to Z we'll be discussing all about what kind of mistakes are there, how it is going to impact the management, and vice versa. Specifically, since it is today's program is concerned and dedicated towards the auditor side, so we'll be discussing, first we'll discuss what it can have an impact on management, and then what is the contrary impact on the auditor. I think this will be the flow of presentation, Ankit.
Exa-
So
exactly.
without wasting much time,
Exactly.
let's.
Also,
Hmm, hmm,
also, how the disciplinary mechanism of institute
correct.
gets functioned and gets activated by any false disclosure, right?
Hmm,
Or any
correct.
substandard disclosure. So not only institute, but even to that extent NFRA, how this entire mechanism is correlated, and we'll try to connect dots. So we'll try to, step one, let's look into what does the standard says. Step two, let's look into what companies are doing. Step three, let's look into what auditors are doing. Step four, because of the misdeeds of certain companies and auditors, how regulator behaves. And
Hmm,
step five, how do you respond to regulator? So I'll try to connect to all dots from practicing and
yes,
from
yes.
management's point of view. But yes, let's start straight away from the change of material accounting policy, Kuldeep ji. And you
Hmm,
being an expert of material accounting policy, right? I want to tell the learned audience here that we have on last 31st March 2023, Ministry of Corporate Affairs issued a notification in which they amended some parts of Ind AS, specifically paragraph 117A to 117E, in which earlier practices were we were writing out significant accounting policies. Now Ministry of Corporate Affairs, through modification amendment in Ind AS 1, expects us to write down material accounting policies. We are on 5th April. That's the right time a company and an auditor build consensus on material accounting policy. And that is why this is the first change which we want to deliberate, which I think as practitioners, Kuldeep ji, the challenge is practitioners have not been able to adapt to this change, because when I discuss among the industry, a lot of top auditors share that the change is only about the nomenclature from significant accounting policy to material accounting policy. When we discuss on the management side, management feels that the materiality is something more about the financial materiality, which the standard has amended to. I and everybody here genuinely require your help into delving into what Ministry of Corporate Affairs have notified and how significant this change is. So I'll first open what the circular is, and I expect that you explain our learned audience. Then I'll open a last year's annual report of some company who has already disclosed material accounting policies. And randomly we can pick up one or two annual reports or financial statements where you can help them to navigate to the change. How do you change a policy? Here, the audience expects that after this session, they are able to rewrite a material accounting policy. How do we do the materiality testing? How do we prepare a materiality matrix? And how from management's perspective it should be looked into. So that will be the flow of the entire session.
Correct.
I am straight away opening the circular first, right? The notification first, and I want you to deliberate on the same.
Sure.
Kuldeep ji, is my screen visible?
Yes, visible. Visible. We are
Okay, just
we.
the circular is visible, right?
No, circular is not visible. We are able to see the folder only.
Okay, just a minute.
Sure.
Now, does it get better?
Yes, it is visible.
Okay, so this is the notification, Kuldeep ji. You can navigate us. This was published on 31st March 2023 by Ministry of Corporate Affairs, right? And what is the change this notification brings, and how do we see that change? Over to you, Kuldeep ji.
Thank you. So basically, Ankit ji, what change has been brought into by the Ministry of Corporate Affairs, it is something which is very important and interesting also. So there are two set of, I would say, people or professionals as of now, who are completely not aware of this particular change, and one who are aware of this change, but still they are thinking that it is a change in which a policy will become material accounting policy from a significant accounting policy. Correct? So what has happened, this change was brought into on 31st of March 2023, meaning by which it is applicable for the financial year 23-24 itself. And what was the rationale behind bringing into this major change? The rationale was that when you see accounting policy disclosure, for what purpose accounting policies were introduced or it is mandated to be disclosed. If you read Ind AS 8 with Ind AS 1, it says that it should tell or communicate about how a particular standard is being implemented in the company, how the accounting is being done, how a particular transaction is being taken care into. But somewhat over the years, it had become kind of a static disclosure in which reproduction of standards language, or when we talk about benchmarking, we had a very interesting discussion that day, that in benchmarking, what I will do, see, if I am a service company, what I will do, I'll check who are my peers. Say, okay, who are my peers, and I'll try to copy what they have disclosed, irrespective of the fact what is the same is applicable on me or not. And now comes the role of auditors, or as a statutory auditor, it is my duty, since I am certifying the financial statement, it is my duty, along with the financial statement, accounting policies are also certified by me. But of late, we have seen that a very little amount of thrust has been given on checking or going through these policies, because over years they have been disclosed in the same way. So auditors or people, professional generally think इसमें क्या देखना है, इसमें तो ये तो it is same what it has to be, what it was in the last year. So this was the rationale behind bringing into this change. Now coming on to the interesting change, or the fact that I was saying, that there are two set of professionals, one who are aware of this process, this change, and one who are not aware. So it is fine for who are not aware, but who are aware of this change, you would notice, Ankitji, that it is written disclosure of accounting policy information. So this is something which is very interesting. So here the change talks about not converting or not judging or testing any policy based on materiality. It talks about checking each and every line which is written in the accounting policy. Each and every line, mind my words, friends. Every line has to be tested through the test of materiality. It is about checking the accounting policy information. So policy information means, Ankitji, that if I am disclosing a accounting policy on property, plant, and equipment, it has to be subdivided into 3, 4, or 5 parts, depending on what treatment or what sort of PPs you are having, and if you are having impairment, if you are having any derecognition, etc. So every word or every line item has to be tested through test materiality. So basically, what MCA has mandated, MCA has given a two type of test. One is essential test, which is given in para 117, which says that any accounting policy information which is material read with the notes on financial statement. So it means that not only a transaction or a policy as a whole has to be material, it has to be seen in line with what transactions have taken place in current year or the corresponding previous year. You want to say something on this, Ankitji?
No,
Or I can.
no.
Correct.
You please continue. I'll sum it up when you come.
Okay.
When you come.
Then there are 6 secondary conditions which has been put in. The conditions are given in para 117B. Then 117B says if there is any change in accounting policy, then it becomes a material accounting policy information. If there is any option being suggested by Ind AS, so if you see like PP, investment properties, intangible assets, or if you see revenue recognition, etc., in these accounting standards, Indian accounting standard, you will see that there is a journal disclosure which is being mandated by the standard itself. So then, if this particular condition is passed, it becomes a material accounting policy information. If the disclosure is such, it is complex in a way that it requires significant estimates and judgments. You see every company publishing significant accounting estimates and critical judgments. Then it will become a material accounting policy information. If there is any the applicability of more than one Ind AS is there on one such transaction, then it becomes a material accounting policy. To sum it up theoretically from my side, that first you need to check whether any policy relates to a material information per se, which is important for the users of financial statement. So take it in a way that, for example, cash and cash equivalents. Will disclosure of cash and cash equivalent have any impact on a decision of a user of financial statement? Cash or liquidity being something which is very important for the users, it will tick this essential condition test. So once an essential condition test is passed, I will have to recheck the accounting policy information for these 6 secondary conditions. So now coming on to the cash and cash equivalent, say if you want to take in a practical example also along with this. So it will take the second.
Kuldeep ji, for practical, I'll open an annual report. Maybe
Okay.
that or a significant accounting policy.
Correct.
To sum it up theoretically, if you're done with the notification, I just have to say, okay, please.
One more thing. So to sum it up theoretically, I would say that it has to pass the essential condition test, which means that it should be material enough to have an impact on the decision of users of financial statement. Second, it has to pass 1 out of 6 secondary conditions. So if both essential and 1 out of 6 secondary conditions are being tested and it is being passed by, then it becomes a material accounting policy information. But Ankit ji, the most important thing comes into play after this. Once an accounting policy or accounting policy information becomes a material accounting policy information, very specifically the notification is mentioning onto a word obscuring. So it means when you see the para 117
117D.
it says that it should not contain any obscuring information. So meaning by which whether a policy information is material or not, if it is a material policy information, it should not contain anything which is obscuring. And I would, Ankit, I would like to keep this discussion of obscuring for the practical part, because practically it will be easy for the audience to understand what obscuring means. So over to you to sum it up, and then we'll move on to the theoretical, practical aspect of.
So I think theoretically, yes, I think all these five, six conditions which you have been telling about, each policy has to undergo this testing. The biggest mistake which auditors are doing today, please note it down. If a condition is tested, right? If the test goes positive, that means you are meeting the essential condition of materiality. And out of these six conditions, you are meeting one of the six conditions, so that you disclose it, so that you disclose the material accounting policy. Now, if this gets passed through, that doesn't mean that you have to, as it is, disclose your material accounting policy. The challenge lies here. The challenge lies that all the auditors and company which I have been looking at are actually rewriting the previous year's policy only, and they have not interpreted it 117D. And 117D is the essence of it. And that is why this change has come, because companies and auditor were reproducing their accounting policies. That is why Institute and Ministry of Corporate Affairs have given thrust on not reciprocating the language of Ind AS or accounting standard while you rewrite a accounting policy. I am surprised that, I'll give you few examples. When you define what is a financial asset, writing a financial instrument policy, what is the logic of doing that? The better way is what in all the categories of subsequent recognition, that is when you are recognizing it on amortized cost, when you are measuring it at fair value through profit and loss account, when you are measuring it at fair value through other comprehensive incomes, you then define that these are the class of category of assets. I am recognizing it at amortized cost. These are the class of assets which I am recognizing through fair value through profit and loss account. And these are the class assets which are my residual category here. So 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 that's the change which we are talking about. Moral of the story: if an accounting policy is standouts to be non-material, right, we will not disclose it. I think here everybody has given consent to it, and industry is majorly acquainted or well versed with this. Where the confusion is, if it is material, then still this policy needs to be rewritten in terms of eliminating the language which has been reproduced by the Ind AS. So that's the crux of the entire story. On this only, I open an annual report, right, in which they have already been putting up material accounting policy change, right? So we'll just run through that change, and what I and Kuldeep are saying, we'll try to demonstrate that this is the problem in the industry, and then we move on the solution side, opening of, or testing. How do you test a material accounting policy? So Kuldeep ji, I hope this is clear.
Yes, yes.
And if you have any questions pertaining to material accounting policies, please write in the chat box. Priyanshu, I request, you can note these questions and we can take up at the last.
Yeah,
Right.
sure, sir. I'll take up the questions as you'll tell me.
Sure.
Okay.
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 So here this report is, Kuldeep ji, right? and I move. I hope this is visible, right?
Visible, visible.
Okay. So I move on the on. This was one of the annual reports. We found that uh, which has been doing the practice of material accounting policy, and we'll try to figure out, what we were what we were just deliberating. So they have written down material accounting policies in the last year only, right? However, when you look into the policy, right? So this policy has translated from significant to material. But when you deep dive into the policies, you will still find the reciprocation of the uh, accounting standards. For example, Kuldeep ji, let's here itself dissect, because their first policy is about foreign currency transactions and translations.
Hmm.
Do you think that this policy still remains to be a material accounting policy when I read to the language of it?
Hmm.
So I'll
It is.
I'll I'll just brief.
Hmm.
Right, you were saying something.
I am saying that it looks like that the language of Indians has been reproduced or
Exactly.
stated here.
Exactly. Now, when in majority of the companies where foreign, however, this being a company in which there is export of services, and that is why they assume that, this is a material accounting policy, because majority of the proceeds comes from export revenue, right?
Hmm. Hmm.
Now, that is why they have put up their first policy as foreign currency policy. The confusion in management's mind is that this materiality pertains to the materiality in terms of
Hmm.
quantification.
Correct.
And
Correct.
that is why they have put it. That is why they have put it. But when you look into the provision, it
Hmm.
says, I am reading out the policies.
Hmm.
Transaction in foreign currency are translated into functional currency using exchange rates prevailing at the date of transaction. Ind AS prescribes you to translate the currency in this way only. There is no alternate way that you can do this, right? Foreign exchange gains and losses resulting from the settlement of such transactions and from transaction at the exchange rates prevailing at the reporting date of monetary assets and liabilities denominated in foreign currencies are recognized in the statement of profit and loss account, and with foreign exchange losses net within result of operating activities except when deferred in OCIs in qualifying cash flow hedges and qualifying net investment hedges. This is nothing but what
Hmm.
Ind AS prescribes you an accounting treatment. There is no estimate, there is no judgment, there is no prior period, there is no change in material accounting policies. The policy is not disclosed in compliance with Ind AS 8. Thus, this disclosure, irrespective, the company has tried their level best to bring the material accounting policy change, is not in line to the material accounting policy change. Right? Kuldeep ji, now
Hmm.
we have our cash and cash equivalent policy opened in this annual report only.
Hmm.
What are
Hmm.
your thoughts on cash and cash equivalent policies?
So, like you said about foreign currency transactions and translation, that it is the reproduction of what India says. Now, I am reading the cash and cash equivalent because it is something which is very common. This policy will be there for almost 100% of the companies. I have not seen any company in which,
So
as
Kuldeep ji, I talked to, sorry, I have to interrupt. I talked to 10 at least 10 auditors and 10
hmm,
companies. Whether
hmm,
are you disclosing cash and cash equivalent policy?
hmm,
9 out of 10 fields, and to the
hmm,
learned audience, I'll open up this discussion. 9
hmm,
out of 10 fields that
hmm.
cash and cash equivalent policy will not be disclosed as material accounting policy.
Because this is something very interesting which you have told all of us. Because when you test this policy on aspect of mortality, what the notification is asked us to do, you see that it takes the first essential condition. Because in my opinion, and you will agree on this, that uh, disclosure of this particular policy can have an impact on the decision of user of financial statement. And
Agreed.
it in
Agreed.
general, it is a significant amount in every company's financial statement. So it becomes and it passes the essential test. Then it is not, if there is a change in accounting policy, we take this answer as a no. Then the second condition comes whether there is any option suggested by the standard itself. Here comes the interesting part, Ankit. When you see, when you read Index 7, you will see that there is an option of presentation of cash flow from operating activities. And as a student, also, all of us have read, and as a auditor, also we certified, and we have seen such footnotes or policies in which it is written that the cash flow is prepared on indirect method set out in Index 7. So again, there is a very interesting problem statement in this. When you write that a cash flow statement is prepared based on indirect method as set out in Index 7, you are writing it wrong, my friends, and we are certifying it in a wrong way. Because what standard says that there is an option to present cash flow from operating activities on either direct method or indirect method, and generally 95% or 99% of the companies do it on indirect method. For the rest two activities, investing and financing activities, there is no option available. It has to be presented on direct method. So if I'm giving a footnote that
Okay, okay,
cash flow,
I got it.
if so it is a very interesting observation that we have also came across last year only, to be very frank. And you see, then when I'm writing that the statement of cash flow is prepared on indirect method, it means for I'm writing it for all three activities, which is a wrong statement and which is a wrong certification from auditor's perspective also. So coming back on the materiality topic, so when you see it passes the essential condition test and it passes the one of the secondary condition test, which is whether the index is giving you an option or not. Hence, it becomes a material accounting policy information. Now comes a very interesting, part. When you read the notification or para 117 per se in letter and spirit about what to be disclosed and what not to be disclosed, it says that it talks about material accounting policy information only. So if you ask me, this policy is a material accounting policy information. It can be covered under that ambit. But if you ask me that whether a separate policy is required to be disclosed, I will agree to you that the answer is no. But with a rider that along with the statement of cash flows, as a footnote, you write that cash flows from operating activities have been reported on indirect method, because this is the option that you must have chosen out of the two options
Exercise,
given in the index.
exercise.
So over to you, NKJ.
I think you made a very valid point. I have
Hmm,
to, give full marks because I'll be honest, to all the attestations even we are doing, right?
hmm, hmm.
Uh, I am sorry to say we still write that the cash flow in the footnote,
Correct.
that the statement of cash flow is prepared based on the indirect method, right?
Hmm,
Interestingly, when you type, so all the auditor community as well as the management and corporate reporting teams of various companies, I think we have to look into this point what Kuldeep has just made, that as a footnote when I am writing that I am preparing it based on a indirect method, the cash flow from investing and financing activities can't be prepared using an indirect method, but
hmm,
automatically the direct method, the option is given for presentation for cash flow from operating activities only. So that is why either we choose this here or choose this as a part of footnote, right, to the statement of cash flow. Got it, Kuldeep ji. Kuldeep ji, I have one
hmm.
more question,
Yes,
and
yes,
then we
sure. Hmm,
move down. When these companies prepare their annual report, right,
hmm, hmm,
in their significant accounting policies, I'll open another annual report so
hmm,
that we have more
hmm.
we have more data and more industry
Clarity.
to talk about, right?
So I
Uh,
think you must be you must be mentioning about that particular disclosure error in which the companies are giving corporate overview or basis of preparation or statement of compliance under accounting policy information. Am I right, Ankit ji?
I have a lot of questions because this is a very vast
Sure,
discussion. I think we
sure,
can
sure.
we can have a we can have multiple sessions only on material accounting policies. But is this annual report visible?
No, not yet.
Okay, let me share it again. Now,
Visible, visible.
okay. So I am saying now we look into this annual report and let's look into the accounting policies. Kuldeep ji, first
Hmm.
question. Whether a material accounting policies will consist current and non-current classification also?
If you ask me, the answer is no. It should not. Though the requirement comes out of Ind AS 1 only, but it should not include current and non-current classification, because I
So
think there
now,
is no.
now companies are not required,
No, not
not
required. Not
required
required. No.
to write down policies of current and non-current classification
Hmm.
unless there's a change in classification
Hmm.
methodology, right?
Correct. Correct.
Okay. And basis of preparation, does it forms part of material accounting policy or should it be above the material accounting policy? Because I put this
Hmm.
question because
Hmm.
fine, it is okay to, while I prepare a consolidated financial statement, I am doing a compliance to Ind AS 28 also, and I am doing a compliance to Ind AS 110 also, right?
Hmm. Hmm.
So
So,
whether the basis of preparation uh, for consolidated financials or even for standalone, what are your thoughts?
in my opinion, basis of preparation, again, it will not come into neither in material accounting policy information nor above the same. You can, dissect this basis of preparation into two parts. One is a statement of compliance, I think, which is given in the first paragraph of this particular basis of preparation, that the company has have prepared, the statement have been prepared in accordance with Ind AS and the Companies Act, etc. It is the requirement of para 16 of Ind AS 1, in which it says that an explicit and unreserved disclosure regarding to the compliance of Indian accounting standard has to be made. So it will come, but it will come over and above the accounting policy information part. It should not be the part of material accounting policy information. And when we talk about basis of preparation, then again, if you want to write it down, then you can, above the material accounting policy information, you can write it about the functional currency or the rounding of option that you have chosen, because after amendment in schedule 3 from 2021 itself, there are multiple options for rounding off which is available as per the amended schedule 3. So if you're writing it down, it is fine, but it should be written over and above the accounting policy information. Rest, basis of consolidation or basis of preparation or writing that I'm preparing on a going concern basis, etc., everything will not come.
Got it. Got it. Last before we close this material accounting
Sure.
policy change, I think with
Hmm.
your efforts, one thing is communicated. These all pages will now be summarized to maximum 3-4 pages,
Correct,
and
correct, correct.
auditors and management has to take care, right? Whether a material accounting policy, is not obscuring. That's important. Any
Hmm.
policy specifically you would want to discuss as a huge case study? Because as of now, we have only discussed cash and cash equivalents, and we have discussed some generic policy. Any policy you want to pick up
Any and
for a
any
minute or two?
any policy you say, we can discuss on the same.
So I
Correct.
don't want to go into the financial instrument policy because that will take a lot of time.
Hmm.
Maybe we can have
Hmm.
another session. Can
Hmm.
we take up government grants if you are comfortable?
I think we should take revenue recognition, if you say, because it is something which will be
It's
there
more.
in.
It's no. Yes, yes,
More
yes, yes.
relevant.
Got it.
S-
I was looking to cut it short because we have a
hmm.
lot of things to deliberate. But let's
And
go.
then I'll
Let's.
so I'll cut it short in a minute or so. So when you see your test revenue recognition policy, that revenue from contract with customers, it passes the essential condition test. Revenue being the most material information for any user, it will pass the essential condition test. Then it again, you see in many cases, there is a option which is being given, as per the Ind AS 115, in which if you are recognizing any revenue over a period of time, then there is input and output methods which are being given, and certain specific disclosures are also required to be made as per Ind AS 115. So over and all, if you have disclose revenue recognition, refund liabilities, rebates, discounts, etc. under your significant estimates and judgment, then it will pass the essential condition test as well as 3 out of 6 secondary condition tests. Otherwise, it will pass 2 out of 6 secondary condition tests, and hence it becomes a material accounting policy information. So when you read this policy per se, to sum it up in short, please make sure that there is no reproduction of Ind AS language. So when I read this policy, revenue from contract with customers is recognized when control of goods or services are transferred to the customer at an amount that reflects the consideration to which company expect to be entitled in exchange of these goods or services. The company has generally concluded that in principle its revenue recognition, the revenue agreements, because it typically controls the goods and services before transferring them to customers. So there is a concept of point in time and pointed time. So this company talks about pointed time, that upon delivery of goods, the revenue will be recognized. So this particular para can be disclosed. Then you need to dissect each and every part of this policy: sale of goods, revenue from combined contracts. Interestingly, Ankitji, when you see when I see interest income and dividend income in a revenue recognition policy, my eyes automatically got lit up. And I would say that, friends, this is not part of a revenue recognition policy. That should not be part of the revenue recognition policy, because it is not your operating revenue until unless you are an NBFC or banking company. Interest income, or an investment company interest income or dividend income cannot be, and it is not part of your operating income. It is given in Ind AS 1 as well as guidance note of Institute of Chartered Accountant in India on Schedule 3, page number 153, if I'm not wrong. You will see the definition of turnover and what is to be included and what is not to be included. So these policies I've seen in many companies, they are giving other income, interest income, dividend income, rental income. These all things are not part of revenue recognition policy. They will go away. Last, Ankitji, on contract assets and liabilities. Contract assets and liabilities per se are part of revenue recognition policy, but it has to be seen in line with what sort of outstanding contract balances you have in your balance sheet. Then only it will become an material accounting policy information. Again, I would suggest that don't write what is a contract asset and what is a contract liability. If you have that only thing to write, then remove it completely. Over from my side, Ankit.
But I think the classification of contract assets and contract liabilities should be rewritten. In fact, there is a FRRB report which states that the classification of contract assets has not been done properly by the company. So people generally don't know what are contract assets and what are contract liabilities. In fact, I see a lot of contract assets and contract liabilities, because where do you trace these contract assets and contract liabilities from? I trace it from my other financial assets and other financial liabilities.
Correct.
There I am able to trace this. And this is a very valid point you have made, that interest income and dividend incomes, right, are not part of revenue recognition policy. When you read this, right, dividend income from investment is recognized when the right to receive payment has been established. Tell me any other way to recognize dividend income.
There's no
It
other
should
way.
not be written. It should not be written at all.
Yes.
Right. So I think there's a paradigm shift from we as practicing professionals writing out these policies or attesting these policies or assuring these policies as a reciprocation of language of India. I recall the days when people, and even we used to deliberate that if you are reciprocating India's number, writing it down, right? We both have done that. It's a good policy. From a state, now we have come to a point there you write a reciprocation of India's, NAFRA comes back, FRRB comes back, right? Your peer reviewer tests these policies and realize that you have not been doing right. So I hope, friends, this was the material accounting policy change which we were trying to deliberate. We are time scarce. We have a lot of information to share. Otherwise, we could have, navigated the entire each and every policy of it. But still, if you want to uh, rewrite a specific accounting policy, you can write down in a chat box. If time permits, we will take it at the end, right?
Sure.
I go back to the presentation, Kuldeep ji, and let us now. We have transitioned from significant accounting policies to material accounting policies. Now I am going back to the financial disclosure side, right? And and this is the only text in the presentation because as we told that what an auditor is expected to do. So the first schedule which we prepare is of property, plant, and equipment, right? And what an auditor needs to see, right? So one, the auditor needs to see whether PP has been appropriately measured by the business unit as per Ind AS 16. Two, whether appropriate disclosures. So now what are the disclosure requirements? The measurement basis. So this is a part of policy.
Correct.
So in PP, you can't eliminate it because the disclosure requirement is that you have to put the measurement basis, right? But now, interestingly, Kuldeep ji, some commonly found error on the first point. Lot of people write PPs are measured, right, at fair values, right, after the Ind AS provisions coming up. Now you tell me that whether all PPs are measured at fair value,
No.
or you have some PPs like land, right, like lands, which might not be measured at fair value, but might be measured at the deemed cost when the Ind AS transition was happening.
Yes,
So,
yes.
to various class of assets,
Mm.
you have to rewrite this policy because all PPs are not initially measured at fair value. Kuldeep ji, if there is a difference of opinion, I want to understand from
Nini,
your point.
I think you are trying to make a point about at a time when the companies transitioned into Index, if I'm not wrong. So,
Correct.
so we see that particular note still coming into accounting policy. So again, going back a little bit to the accounting policy information part, this type of disclosure, that what treatment we have done at the time of initial transition to Index is not required as of now. It is the talk of past and it has gone. Now, when you see Index 16, it says that there are two options. At initial recognition, it has to be measured at cost only. So there is no option. So this needs not to be reproduced or it is not required to put up into the accounting policy information. So the interesting part comes into play at the time of subsequent recognition. So if you are choosing an option of keeping an asset on cost, then there is no point in making these sort of disclosures. But if you are going on revaluation model, then things become different.
Absolutely. So that is measurement part. The second is the depreciation method deployed, right? And again, you have an option to choose a depreciation method. Interestingly, Kuldeep ji, and there the problem comes. The third is the useful life of the asset. And almost every company mentions the useful life based on the Schedule 2 of the Companies Act in their accounting policies of PPE. Agreed?
Correct. Agreed.
Now the class of assets which has been given as an exhaustive list by Ind AS 16 as well as by the Companies Act, companies are not classifying their assets based on it. So you see that there are different class of assets in the depreciation schedule, and when company present their gross carrying values and net carrying values, then there are different class of assets. Problem number one. So that has to be in synchronization. Whatever class of assets you are mentioning in your accounting policies, make sure when you put up a note or schedule to your PP, the same is mentioned. And I'll show the example also, right? Second, what if there's a difference between the useful life your management has estimated and the useful life of the Companies Act. And if this difference exists, then how does management respond to it? Question number one to you. And how does auditor respond to the management's estimation? ऑडिटर साहब तो अटेस्ट करके निकल जाते हैं कि भाई मैनेजमेंट ने एस्टिमेट किया है. In fact, sorry, I am opening this up to another index where when we write valuation of inventories and there are so many disciplinary cases going by FRRB, going from FRRB, where auditors have disclosed inventories as certified by the management or as verified by the management, because that used to be a conventional practice while we used to take a management representation letter. Similarly, in PP, auditor now certifies whatever management has estimated the useful life. We are agreeing to it. So I have two questions. If I've opened this up too much, I am again consolidating first from PP point of view. First, from PP point of view, if there is a difference in useful life, what management estimates and the Companies Act does, how does a management has to disclose it? What disclosures management is expected to make out of it? Question number two, if auditor is not satisfied with the useful life what management has estimated, I am sure the auditors must be testing these useful lives with the management, because auditors are expected to test it, right? Then how does auditor report it? So management perspective you answer, auditor's perspective I will answer if you are comfortable.
Correct. Correct. So what you have said, if there is any, I would like to make 2 points out of this. When you read Schedule 2, which prescribes the useful life for depreciation of various class of assets. So there is one important thing. I have used the word prescribes, but it doesn't prescribes. It indicates, or it gives an indicated list or suggestive list of what a useful life can be for a particular class of asset. Again, it has to be customized, or it has to be seen in line with the operation of your own entity, company specific. So here comes your question. If there is a difference between useful life indicated or suggested by Schedule 2 and what management has adopted, then there has to be a comparative disclosure which is required to be made by the company in its accounting policy information, writing that this is the useful life which is indicated as per Schedule 2, and this is what we have adopted. And it is difference coming out specifically that it is different from what is being indicated in Schedule 2. And the reason of difference, for example, if a plant is running on 3-shift basis, obviously the time in which it will depreciate will be different from what a standard operating process has been defined in India's. And encroaching a little bit of what you will deliberate, what auditor should look into. So I agree to your point. I buy your point that we often, without looking at what the company has written, we certified, and I have not seen almost in majority of cases an auditor or auditor firm verifying the estimation of management. So it is very important that you verify it, whatever condition or whatever policy or SOPs the company has in place for specifying a specific useful life for any asset. It has to be verified by you. Over to you, NKG, for detailed deliberation.
So I'll sum this up. One, if there's a difference, you're right. I think we should mention the corresponding useful lives, corresponding useful lives by the management as well as the Companies Act, so that the difference is that company is transparent about the differences. Now the problem is you just can't merely give a statement. What I interpreted it from what Kuldeep has said, we just can't merely write that management estimates, right? So he gave a use case because my plant and machinery works in 3 shifts, right? Because the company is operating in 3 shifts, or because of whatever the factual reason is, that also needs to become part to the policy itself. That if there's a difference, and that is expected to be disclosed also in compliance to Ind AS 32. The second point, see why I'm telling you why does an auditor should test a useful life? Because if the useful life increase or decrease, my depreciation changes. When my depreciation changes, it has a direct impact on my profitability. It is a material material impact which this useful life will have. And that is why auditor should always retest on sample basis or re-verify the documentation which the company has created for testing the useful life. So if it is not in satisfaction, the auditor has to report in compliance to the CARO also, and auditor has to report in their auditor's report also that there's a there cannot be scope on this thing. There could be a qualification pertaining to specifically if auditor is not satisfied with the useful life which management has estimated. So Next we move ahead. We say gross carrying amount and accumulated depreciation at the beginning and the end of the period. So that is something which needs to be disclosed. We will come back to the annexure after this. The existence and amount of restrictions on title of PP pledged as securities for liabilities. Kuldeep ji, I find a major disclosure. Companies with their PP schedule does not fails to disclose, I am repeating it, fails to disclose in their footnotes of the PP which they have pledged. This is a
Yes,
Ind
correct.
AS disclosure requirement. Next is the impairment losses reversed or recognized in profit and loss in accordance with Ind AS 36. That also needs to stand out here. And last, if there are assets held as sale in accordance with Ind AS 105, then this also needs to be disclosed. Kuldeep ji,
One
because
thing.
follow.
One thing, sir. Sorry to interrupt you. One very important thing which I would like to mention that as it has come to our knowledge also, and since me and Ankit often work very close with the NAFRA authorities also, there is a major review going on, which has come to our knowledge by NFRA for various big auditing firms, and in this 36 as well as the impairment of financial assets. These are one of the two most important accounting standard disclosures which they are looking at from company's perspective as well as auditor's perspective. So while we talk about impairment, it has to be seen very specifically by the auditors.
So Kuldeep ji, I open this up more. So this was the Ind AS 16 compliance which auditor and management has to do. Now I am moving to Ind AS 38 compliance because post intangible, I have two notes written up. One is title deeds which are not in the name of the company, which we will deliberate together. The other is capital work in progress, and then comes the intangible. Correct, Kuldeep ji?
Correct.
That is the chronology of a financial statement. I am covering this both because I have now specific case studies based on it post this slide. So what Ind AS 38 says, okay, let's not look into Ind AS 38. Let's first look into the compliance of Ind AS 16. I'll open up Ind AS 38 post this. Now this is what a large FMCG conglomerate has done, right, on their financial statements. They are reporting their property, plant and equipment, their CWIPs, their investment properties, their goodwills, their intangibles, their right of use assets, right? All in there. This is end of the financial statement. What is left after this? So that is why you have to check and set out the right standard requirements, right? We have to look into what is the righteous way to disclose it. I am not saying this is wrong or this is right. I am saying my Ind AS 16 requirements are so huge. How will I put this with all these annexures together? And then I have my Ind AS 38 requirements, right? Now, when I say depreciation and amortization coming up together, now Kuldeep ji, what is expected by Ind AS is, right, the accumulated depreciation at the beginning of the year and the end of the year, and accumulated amortizations, impairments at the beginning of the year and the end of the year. This can't come together. There has to be specific columns highlighting what is my accumulated depreciation.
Correct, correct.
You genuinely want to be transparent to the user of the
Hmm,
financial statement?
hmm,
If
hmm,
yes, then how can accumulated depreciation and impairment be put together?
hmm,
Does depreciation and impairment mean same thing, Kuldeep ji?
hmm.
If a
No, it's
company
not
is having if a company is having
completely
accumulated
different.
depreciation, right, to a greater extent, to a material extent, don't you think that the machinery is getting redundant? Is
Hmm,
depreciating far more quickly than what was expected?
correct.
And that is why these figures should not be accumulated together.
Hmm, hmm,
That is the only reason I have put up this annexure. And
hmm.
not this company is doing, almost every company is doing.
And one more thing, Ankit, because what you have mentioned in the previous snapshot, all these things, the disclosures come out of it, different Ind AS disclosure requirements.
Exactly.
So
See
you
the
cannot
heading. That
club.
is what I say.
Yes,
You
yes,
have put. I have not used India's 40 because you have investment property also coming up
yes,
here.
yes. Hmm,
Then how do Kuldeep ji? How do I show what were the costs which were incurred for the investment
hmm,
property which were given on rental, the repairs and maintenance cost?
hmm.
Isn't it a India's 40 disclosure?
Yes, yes, it is. It is.
So friends, there is goodwill coming. So goodwill comes from business combination. Otherwise, there will be no goodwill.
Hmm,
And when you read the index of business combination, the standard sets out 20, 30, not 2, 3 requirements, 20, 30 separate requirements. The reasons
hmm.
why did you recognize the goodwill, the synergical effects of a business combination which made you recognize goodwill. So many things. My point here is, my simple point here is also, Kuldeep ji,
Hmm,
let's see what India says. India says you have to disclose the gross carrying amounts and
hmm,
the
correct.
accumulated depreciation at the beginning, at the end, and the
Hmm,
net carrying amounts.
hmm.
Now it looks like that this is a 15, 20-year-old financial statement. When you write book values,
Agreed. Agreed.
we have transitioned to India's way back, right?
Hmm,
I don't say that there's a difference in meaning of writing a net book value or net carrying values.
hmm.
But that's something which we have to now
Which is happening.
constantly start. You know, that is why these sessions have become important
Hmm,
because these are those things on which NAFRA comes up. These
hmm,
are those things which FRRB highlights. And you don't have, as auditors, as managements, we don't have justifications that why almost all the companies are putting up their accumulated depreciation and impairment together.
because these two
Now,
things are altogether separate, Ankitji. To interrupt, one is basically out of the requirement of an Indian accounting standard, but more from a subjective perspective, impairment thing, and one is coming out of from rates set forth in or indicated in the schedule 2 or whatever you choose. So these two requirements and the impact and the intent of these two requirements are completely different also. An auditor
exactly.
being auditor being the other side of the coin, whatever mistake as a company I am doing, if I am certifying a financial statement, I am equally responsible for the conduct of or for the mistake of particular
In fact,
disclosure.
Kuldeep ji, the
Hmm,
irony is
hmm,
that FRRB, when picks up these cases, right,
hmm, hmm,
they 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 eventually ask queries to the auditors.
hmm,
And now is when we are deliberating on this fact when we should start asking this from the regulators and from the companies because ultimately the preparation of financial statements rests with management.
hmm,
But again, I am saying that I think that it's time that we have to be very cautious.
hmm,
Also, as I told you, in all these cases, you will see the useful life which the policy mentioned,
hmm,
right? The category of the assets, the class of the assets are different, right?
hmm,
Look into, the broader class of the assets which you have to come up with. And so this is a better practice because they are moving from gross carrying value to net carrying value, but still it requires certain modifications, right? That is the standard practice which majority of the companies follow. these are the kind of standard practices which companies are following, right? Uh, this would, I would say, is a better practice. You will see that, that there's a clear distinguishment coming up. These all two, three comes from IT industry. The first one was a conglomerate, right? And here you see the useful life. This is now intangibles coming up after this. So you see useful life also. But before that, let's deliberate what is India's 38 requirement, and then we move on intangibles. I hope the learned audience is clear about uh, what, as an auditor, what all you need to see in compliance with India 16. As management, what all should be given. Uh, and I told you two, three major mistakes. One, writing up your accumulated depreciation and impairment. Two, estimating your useful life. The class of assets which are disclosed in material accounting policies are different from the class which are there, right? Three, uh, in terms of pledging these assets, right? We have to be very, very careful. If there are some assets which are pledged, it comes out of a mandate of India 16. You should, lot of people put up the note in loans and borrowings, right, Kuldeep ji? That these are
Yes,
the
sir.
assets which are pledged. You are actually expected to disclose the carrying amount these assets which have been pledged as securities in the footnote of the India 16, because the mandate comes from India 16 itself.
Correct,
So
correct.
so three, four things, please take care. This is an important index. For manufacturing units, this makes a lot of difference. This is the first index as a regulator which has been tested. Uh, also, with this, Kuldeep has rightly said, if every regulator is just talking about two policies, depreciation and amortization. And that was the idea to start with Index 16. I moved to Index 30, 38 intangibles. Kuldeep ji, see what auditor should see and tell me, give me 5 reports which comply to only these 5 points, 5 financial statements. I did not found it.
Same
How
here.
many companies are how many companies are classifying whether the business unit has disclosed each class of intangible assets? Problem number one, distinguishing between internally intangible assets and other intangible, and other also needs to be bifurcated from acquired through a business combination and then the other intangible assets. So eventually your disclosure note should disclose 3 things. One, whether you have acquired internally, right?
Correct.
So when you look at this note, tell me what intangibles they have acquired. So they have just given the detail of the acquired. What about the business combination? What about if there are some internally generated intangibles? So you have to talk about it. Second, whether the gross carrying amount and the accumulated amortization at the beginning and the end of the period, right? So please don't use the word impairment here. Index expects you to amortize it.
Amortize. Correct.
Impairment losses recognized. Now there is a separate point on impairment losses, right? Any increase or decrease during the period resulting from revaluations or impairment, all this needs to be disclosed with your intangible assets, and the 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 auditor should also identify the aggregate amount of research and development expenditure recognized as an expense during the period. Now, Kuldeep ji, I'll show you all top companies' financials. I don't find it. I don't find it. And that is the fear in my mind, that what do managements do out of it when regulators start questioning them, right? What do auditors will do into such a case? And how we reach to an excellent practice. Now there we find the first time this company has actually classified it into indefinite life and definite life. Yes, Kuldeep.
One small point I want to make, Ankit ji, here. In case of intangible asset, when you read Index 38, you will see para 88, if I'm not wrong, specifically requires you to define or identify whether an intangible asset is having an finite life or indefinite life. So it comes out of requirement of Index only. So if we are not making the disclosure that we have discussed as a company or as an auditor we should look into, we are making two mistakes. One, we are not complying with the requirement of specific disclosure things. And second, we are not being, we are not, transparently disclosing what a user of financial statement should have a right to look into. So when you talk about indefinite useful life assets, it may be an example goodwill, perpetual franchisees or trademarks can be an example in case of a service based company, or in case of a company which is having research and development or related activities in its business ambit. It becomes very important because for these sort of companies, indefinite or finite life intangibles will be of something of a very important or a considerable amount per se, like you are showing in this particular snapshot that these intangibles are worth crores of rupees. Ankit ji.
So also, the earlier annexures pertain to IT companies, right? And here you see this intangible classification is only customer related and marketing related. Boss,
Hmm.
this can't be based on the industry. This has to be based
Hmm.
on the standard.
Hmm.
So when you say marketing related, at least this company, the other peer company in IT has presented their
Hmm.
customer related fine, and the
Hmm.
marketing related into software, in
Hmm.
IPRs, brands, trademarks,
Hmm.
others, at
Hmm.
least give a fine categorization of classification of these assets. You guys
Hmm.
are big conglomerates, you're big companies, right? Whatever
Hmm.
practices you guys adopt, the others
Hmm.
actually follow it.
Hmm.
So, so now, very important thing, right?
Hmm.
Only this company you see in a footnote that they
Hmm.
have mentioned the total research and development expense which they have recognized.
Hmm.
And this is a fantastic practice. You don't see anywhere else. See,
Hmm.
you don't see what is
Not
the
seen.
impact of revaluation reserve.
Hmm.
See, there are I have given only five requirements, but none of the company is filling all the five.
Yes, yes,
Someone
agreed.
is disclosing, someone is
Yes, X
disclosing
and
the,
hmm.
the gross carrying amounts and accumulated, but they're not disclosing it, the accumulated amortization or impairment separately. Someone is not able to disclose what is the increase or decrease during the because of the revaluations or impairments. Also, if it is not there, you still have to give a footnote because this is a Ind AS disclosure.
Yes, yes,
With
correct.
these 5 points I have captured out of the disclosure requirements of Ind AS 38, in which you are just expected to give a positive assurance on whether if there is no revaluations or impairments.
Hmm.
So so I hope all these things can't be clubbed together. You
Hmm.
have uh, you have a lot to do for each disclosure and schedule you prepare. When you prepare a right of use asset, when we open up Ind AS 116, there are
Hmm.
so many requirements. How do you disclose a short-term lease and low-cost lease, Kuldeep ji?
Hmm.
You have to come out and say about it, bhai.
Hmm.
You can't just put a note to it. So, anyways, I am not opening this up too much because we have other
Right.
issues to touch
Other
upon,
issues to discuss.
and we have 20 more minutes to go. Then we only take up questions, right? So, Kuldeep ji, what is wrong in this disclosure? And I want audience to write it in the chat box
Yes,
also.
yes,
What do you
correct.
think is wrong in this disclosure? I hope we will be able to access the answers. But what do you think is wrong with this disclosure?
With a rider, Ankit ji, that whatever we'll discuss post your answers, this comes out of from a requirement of a guidance note. So it is
Okay,
applicable mandatory for the auditors.
auditors. Okay, okay. So we after this, I told you after the property, plant and equipment, below we have to give a note
Hmm.
on title deeds not in the name of the company. Kuldeep ji,
Yes, yes. Hmm.
just for there might be some novice audience also, young CAs also,
Hmm. Hmm.
which might be learning all these top-notch skills. How do you, you know,
Hmm.
uh, make up a financial disclosure. I want you to please, by the time that answer comes, from where this mandate comes.
So, Ankit, this mandate comes out of the amended Schedule 3, 3's requirement. So, Schedule 3 was amended in 2021. It was applicable for FY 2021-22 and onwards. So, this particular disclosure requirements come out of amended Schedule 3, which was amended to make it in line with CARO 2020. So, it is kind of a similar sort of requirement which is there for the auditors to report in CARO. So we, as a auditor, we have double of the responsibility. One, we are reporting it in our auditor's report as a CARO annexer. Second is, since we are certifying the financial statement, whatever is being given in the financial statement or the compliance related statement, we are certifying the same. So it is a dual responsibility on auditor. So this requirement comes out of from CARO 2020 as well as for companies amended Schedule 3.
Okay. Now, what's wrong, Kuldeep ji? Let's deliberate on it because I don't think we'll be able to access the chat box, and we'll bother Priyanshu at 2:45 only. But I hope we had some answers to this. So now, what's wrong?
So there are two things which one has to have a look on while making this type of disclosure. One is if the title deed is not held in the name of company, what is required to be disclosed? It is given in the last column, that reason for not being held in the name of company. So whatever we have seen, Ankit, if you will agree to on this point, on hundreds of annual reports or hundreds of financial statements we have seen, companies are writing the present state of situation, right, rather than writing the reason that the companies are. Yes, please.
I am saying I have seen financial statements of relatively smaller companies, because this is a bigger, this is a huge conglomerate where people have not even written the reason.
Yes.
So that is a grave mistake, and this mistake is as good as not writing a reason.
Correct.
This is as equivalent, because if I write pending litigation, what message I am trying to communicate it to my stakeholder? Now over to you. Sorry, what is expected to be written?
So one thing which is expected to be written is the reason for not being held in the name of company. For example, I bought a plot or it has been merged into my company due to some corporate restructuring, etc. So I cannot blindly write that it is under process of registry or it is under process of registration. I need to write the actual reason for the delay. Point number one. But when you talk about litigation, Ankit ji, there is a specific mandate which is given on guidance note on Schedule 3, which has been published by ICI only, which says that if the reason is pending litigation, then you need to mention or you need to state at what state the particular case is at. For example, this company has given that the company has filed a suit which regards to the title and is awaiting a decree. Again, it is not the correct, but it is a better disclosure. But I cannot write, specifically pending litigation, because pending litigation may be at any stage of a legal dispute. So the answer is that I need to write what is the current state of the case, legal dispute which is going on. On the other side, if someone asks that do I need to write, because there may be 5, 6, 7 or 10 dates or 3, 4 dates also in a year, so I need to write or I need to update each and everything, the answer is no. The case can be divided into critical milestone and critical stages, and according to same, you need to state the what is the critical milestone or stage at which a legal dispute is. Over to you, Ankit.
And also, I think the importance of the last column is aligned to the second last column, right? Which says how long these things have been pending.
Correct.
A case from 1981 to 2024 is pending. So we also need to look into the time duration from it is pending, and that's how you have to substantiate the reason. Also, the gross carrying value. I am just not saying that So something is if of, less than a crore for this company might have to, because these are
Mm.
not major things. But
Correct.
something which is of 34 crores, right,
Mm.
could be material for the user of financial statement, right?
Mm.
And these are gross carrying values of a building. So this might, the- the valuations might be entirely different.
Yes,
And
yes.
similarly, so always look into these two things before you write this disclosure. Kuldeep
Mm.
ji, another inquiry made by FRRB,
Mm.
right? And as I told you, FRRB has been very active.
Mm.
Now, one thing you told very interestingly, that the methodology of preparing a statement of cash flow, right? The other the other thing is, which I'll just take up a minute, that how disastrous a mistake can be, a small mistake can be,
Mm.
right? So this company has, or not this company, I can name 10 companies which have written cash flow statement, right?
Mm.
Now,
Mm.
boss, again, this displays the meticulousness with which a company and their auditors have prepared their report.
Mm.
They are an Ind AS compliant company.
Mm.
A wrong nomenclature, right, Kuldeep ji?
Mm. Mm.
A wrong nomenclature can be a greatest mistake in the eyes of regulator.
Mm.
We can't use cash flow statement. Instead, we have to use statement of cash flow, right?
Mm.
That's what Ind AS. These are these three primary statements which are certified by the auditors.
Mm. Mm.
When you ask to define a financial statement, what are financial statements? They
Mm.
comprises of statement of cash flow. So in your auditor's report also, if you are attesting a Ind AS compliant companies, right, you have to be very clear about the nomenclatures. To name more issues, right? To name more issues, and these are big companies. That's why I am coming up. Before we come on this note on asset held for sale, Kuldeep ji,
Mm.
I'll tell you how FRRB is identifying. I'll take top five queries of FRRB, and then we
Mm.
move on this. Query number one, Kuldeep ji, where FRRB found that, and even the QRBs, that the purchase and sale of fixed asset
Mm.
has been shown on net basis by the company and the auditor,
Mm.
and the auditors have certified it, right?
Mm.
So the purchase of fixed asset and sale of fixed asset, can it be shown on net basis? Question number one.
Mm.
So, so even when accounting standard was applicable, right, and it is
Mm.
still applicable, right,
Mm.
you can't show it on net basis. That
Correct.
is that is a top point for from SME's perspective, which
Mm.
FRRB found.
Mm.
Second, second, with regard to the valuation of inventory,
Mm.
specifically the raw materials, right?
Mm. Mm.
Companies are mentioning that they are using average cost method
Mm.
or some different terminology like moving weighted average cost method,
Mm.
right? These are grave mistakes. While you write down your accounting policy, I hope everybody is clear that the terminology,
Mm.
and maybe you are still valuing it by moving weighted average cost method only or weighted average cost method only, but the terminology which is to be used is weighted average cost method. Even any other terminology will put up a, I can assure you, will put up a FRRB or a regulator's inquiry. Every company will receive it in times to come.
Mm. Mm. Mm.
Everybody is
Agreed.
undergoing that
Agreed.
scrutiny.
Mm.
Kuldeep ji, then I found FRRB,
Mm.
more reports which says that finished goods
Mm.
are valued. I am talking about basic things because you told कि हम सुई से एरोप्लेन तक जाएंगे.
Yes,
कैश
yes,
फ्लो
correct.
स्टेटमेंट लिखना और स्टेटमेंट ऑफ कैश फ्लो लिखना सुई के बराबर है.
Mm. Mm.
और और किसी की फाइनेंशियल इंस्ट्रूमेंट पॉलिसी को लिखना या फाइनेंशियल इंस्ट्रूमेंट्स की फेयर वैल्यू हायरार्की डिपिक्ट करना is as good as reaching to the aeroplane. So we are discussing both issues. The third issue which was highlighted by FRRB was again pertaining to valuation of inventories, and which the finished goods were to be valued at cost or NRV, whichever is lower. And in 90% of the cases, companies who were valuing at NRV were not arriving at right cost. For example, when you arrive at cost, you have to consider the depreciation and factory overheads. Now, if you have not considered depreciation, thinking that my NRV is lower than the cost, right, then also you are guilty of the professional misconduct.
Correct.
Irrespective the inventory were to be valued at NRV, will be valued at NRV because NRV is lower at cost, and anything which you add up to the cost will only add up. That is why that reason doesn't suffice. Fourth, I told you in the beginning only, where still lot of SME auditors are attesting, writing down that inventories are valued based on the management or management certificate. So auditors can't, please don't attest any financials in which the schedule of inventory you have written that as valued and certified by the management. No, you are responsible to verify the valuation which the inventory has been arrived at. Fifth, the classification of financial assets, non-financial assets, contractual assets, non-contractual, contractual liabilities. Fifth issue which FRRB feels is most relevant is pertaining to the classification which these companies have been doing so. And the largest of the largest companies are still not clear as to what classifications, how do we do a righteous classification. Companies fail to suddenly from classifying to their non-current assets, they start classifying into current assets, right? Specifically in terms of loans and advances and everything. And last, the impairment thing. So impairment, we will cover this further, but all these issues, they sounds, I have identified basic issues. I have not talked about we have not talked about anything which requires a higher degree of skill or or meticulousness. It only require our basic skills, and where FRRB finds that auditor has not even exercised its basic judgments, or where regulator finds that company while preparing their financial statements have not even complied to the basic things, there the penalties are more grave. So that's the point which I am trying to make. For a complex disclosure of financial instrument, a regulator might think that there might be an interpretational issue. But what if you write a statement of cash flow statement to cash flow statement, the regulator is already perceived with the financial statements which he is reviewing. Over to you, Kuldeep. Let's look into asset held for sale. We have exactly 5 minutes from here.
Correct.
And then maybe, we can open up this to Priyanshu maybe after
Yes,
7-8 minutes.
So one more thing to the wrong nomenclature things that you mentioned, Ankit, and it is very important for SMEs also, because when you see balance sheets of smaller companies or MSMEs, you will see that there's a lot of these type of mistakes happening, because one maybe they don't have that type of team and infrastructure with them, or they or professional accessibility may be an issue. But still, for example, in cash flow or statement of cash flows, you will see still many of the small companies I've seen, they are writing fixed assets in place of property, plant, and equipment. So I don't see like interest and dividend both in investment activities. So these are type of mistakes that you have already discussed. So coming back on the asset held for sale, this specific disclosure requirement comes out of Ind AS 105. So there is two important things. One, if accounting policy related to the same is required to be disclosed, when you test it for materiality basis, material accounting policy information basis, the answer comes out to be no. Now coming on to the qualitative and quantitative disclosure which is required to be made as per Ind AS 105. So rather than going into what this company has disclosed, because it is basically a reproduction of Ind AS's language, there are two important things as we discussed in case of title deeds not held in the name of company. In this case also, if any asset is being classified or identified as asset held for sale and is disclosed separately, there has to be a reason associated with the same and it is required to be disclosed. Point number one, this is part of the qualitative disclosure. And when you talk about quantitative disclosure, you see that the amount of land is same in both years, the amount of building is almost same, and furniture fixtures is not zero because this company has a policy of not showing something below a specified limit. So it may be 50,000 or lakh rupees or whatever it is, it has not shown into this particular annexure. But what is wrong into this? The thing which is wrong is that when you classify any asset held for sale, it can be classified as held for sale only if the company anticipates and the sale is probable in the coming 12 months. So there is a clear-cut requirement which is given in para 9 of Ind AS 105. And when you read it along with Appendix B, which is given in Ind AS 105, you will see that if the situation is beyond the control of company, there has to be a justified reason, and that reason is required to be disclosed why the sale was not made possible in 12 months. Point number one. Point number two, then the question will come from a company side or auditor side. How do I do that? For example, I have classified this particular building as to be held for sale because I'm not going to use it for the business purpose further, but I'm not getting a good price. Uh, this may be a situation when it is a valid reason that I'm not getting a good price and I cannot sell a asset worth 10 crore rupees at 50 lakh or 1 crore rupee. It may be a situation. See this example, Ankit, in which buildings were at 11 crore rupees and now they are at 10 crore rupees. So to make a case out of it, you can do is that you can disclose certain additional detail as a footnote below this note that yes, this is the reason due to which the asset is not being sold, and like we have classified 2-3 assets or 2-3 buildings to be required to be sold and we have sold one out of them. So it becomes in kind of an informative as well as compliant note in respect of 105. Over to you, Ankit.
I think we should, quickly look into only one thing,
Yes,
which
yes,
is again a common problem which
yes.
QRB, FRRB, NFRA, SEBI has been talking about is the non-disclosure of provision metrics. And then we conclude the session. What are your thoughts of, why this provision matrix is not correct and what is the correct way? What is the provision matrix? Question number one. Why do we have to even disclose it? Which Ind AS we are talking about here? A little brief to our audience, and what are the best practices of disclosing a
Correct.
provision matrix?
So, when you talk about provision metrics, Ankit, this becomes more important from auditor's perspective because there was an very specific kind of a I will say a landmark judgment or a notification kind of thing. It was not a notification per se, but it was a landmark judgment in which NAFRA is clearly you know uh, discussed in detail about
It
the
is it is
disclosure
it is
requirement.
with it is with PSP projects. You can
Correct,
download that report from
correct, correct, correct.
FRQRB from
Hmm,
NFRA's website. And
hmm,
why this provision matrix is so much discussed about? Again, this provision matrix is nothing
hmm,
but a non-compliance to impairment in there's
hmm,
only impairment of the
hmm,
financial assets.
hmm.
Right.
Correct, correct. So, what is the main requirement which is there in disclosure of provision metrics? It is about the default rate which the standard want us to disclose, as well as NAFRA came out specifically and categorically on the same. that the default rates are required to be disclosed clearly? And do you think that the particular disclosure which is there on the screen is a provision matrix? In my opinion, it is not, because the default rate is not coming out properly. So the second important point in disclosure of provision metrics per se, before we discuss what a right practice is that involvement, or taking the fixed deposits, or bank deposits, or mutual funds into the ambit of ECL per se, or testing them for impairment. Because previously we everybody had an opinion that if any fixed deposit or any bank deposit or mutual fund is kept within nationalized bank, or any if a deposit is being put in with a consortium which is led by SBI, to be specific, it is not required to be tested for impairment. The answer was given by NAPRA in negative. They have said that no, it is a financial asset and it is required to be tested for impairment, and it will. For this also, you need to prepare in provision metrics. Be it a case that the default rate is zero. So what we are seeing is slightly a better practice in terms of disclosing the ECL on trade receivables, to be specific. We are not talking about other financial assets. So here the company is categorized. We have this information, I think, hands-on, because we are preparing the aging schedule as per in amended Schedule 3. And then the company has written expected default rate or loss rate, and the expected credit loss has been calculated. So this can be termed as a better practice in comparison to what not disclosing and disclosing it in a wrong way. Over to you, NKG, to give the final
So I think
concluding remarks.
so I think there are two things. One, the ECL which you were deliberating on trade receivables, and this
Mm-hmm.
advisory also came on last 31st March.
Mm-hmm.
Advisory came on two, three things. One,
Mm-hmm.
while you write a financial instrument policy, right, the trade
Mm-hmm.
receivables are part of your financial assets. How
Correct.
do you measure it?
Mm-hmm.
How do you initially measure it? How do you subsequently measure it? Right?
Correct.
Lot
Mm-hmm.
of companies were mentioning that they are measuring it at fair value,
Correct.
right? Whereas, whereas unless they form a significant financing components, they need to
Mm-hmm.
be measured at transaction
Transaction
cost,
price. Correct.
right? Transaction price. So one advisory. Two, the advisory talked about disclosure of a provision matrix,
Mm-hmm.
which till last year, this year, let's see what the results are. Till last year, I don't think even 10% were disclosing a provision matrix.
Correct.
Third, when a company discloses a provision matrix, what is expected? The
Mm-hmm.
expectation is that the user should be able to find out the default rates, that
Mm-hmm.
whatever see, if you look at this provision matrix on your screen, it is evident after 180 days, 20% of my trade receivables have to be written off.
Mm-hmm.
And as we move to 1 year,
Mm-hmm.
right, my 100% trade receivables are expected to be written off,
Mm-hmm.
which means, which means that after 180 days, the company has to be more sensitive,
Mm-hmm.
because once it breaches the 365 days period, 100% of its trade receivables will be written off, right?
Mm-hmm.
And you can see the improvement in the company also, because they were monitoring it and disclosing it. And
Mm-hmm.
because on an investor call, this was asked from the company also, that
Mm-hmm.
what measures are you taking
Mm-hmm.
while we were at 181 days to 365 days, the earlier loss rate was 63.96%, and
Mm-hmm.
now company has brought down to 20%, which
Mm-hmm.
shows that company is committed enough to
Correct.
bring their default rates down. That's the idea of a provision matrix, and that nobody needs calculations and computations. The user wants as
Mm-hmm.
to what extent in his, while he's evaluating a company, he should
Mm-hmm.
consider trade receivables as genuinely good,
Yes. Yes.
right? So that is one thing. With this, I think, Kuldeep ji, the other
Mm-hmm.
point which you touched upon was, how do you disclose your expected credit loss right, for other financial assets, and you see this company has been doing it. I even do not find these calculations with most of the companies who are, preparing their ECLs, right? And while you talk about other financial assets, right, I think it is important to define what are my other financial assets.
Mm.
So this might constitute my fixed deposits also, as you were talking about, that, whether fixed deposits are expected to be impaired or not. Yes, they are
Mm.
expected to be impaired, even if it is
Mm.
with the State Bank of India consortium.
Mm.
So with
Mm.
this, I think we sum that up, Priyanshu, uh, you know, with to whatever extent we have tried to cover maximum disclosures. But it was wonderful deliberating at
Yes, I
your committee for members in practice, and kudos to all yours and Alok ji's effort
Yes,
that
sir.
we made it happen at in less than 72 hours. Right. Thank you so much, everyone. Thank you, Kuldeep ji, and
Thank you.
over to Priyanshu for if we have to take up certain questions.
Yes, sir. Actually, we've received some questions. So, first one is for Ankit ji. Does all cases identified by FRRB refer to disciplinary directorate of ICI?
So interesting. So earlier FRRB used to, Priyanshu, only uh, give advisory as to how do you comply to a accounting standard and how well you can comply. But you sitting on the regulator side would know it better. Now FRRB, where the mistakes are found to be materially misstated, there FRRB refer those cases to disciplinary directorate. And the
Correct.
first plea of respondent is that since there is no complainant, so nobody can fill a form 1 to file a complaint. And how institute is suo motu regulating it, but institute is empowered, FRRB is already
Mm.
empowered to take these cases to disciplinary directorate, and the number is constantly increasing, and that's a worrisome point. Priyanshu, next question.
Yeah. Next question, I'll let you know, sir. This
Mm.
is for Kuldeep ji. Do you think
Yes, yes.
material accounting policies change in definition of materiality in compliance with LODR and same?
So basically, Priyanshu ji and Ankit ji will appreciate this fact this the change in material accounting policy information and materiality are two completely different aspects and two completely different domains. One comes out of requirement of SEBI LODR per se. This change was brought into via a notification which was effective from 14th of June 2023, in which it is basically it is related to disclosure of material events and information which is happening in and around the company. So there is a specific quantitative threshold which has been defined by the that particular LODR regulation, which says that it is a 2 to 5% Ankit, a specific quantitative threshold. It is based on the absolute profit and loss of past 3 years, absolute turnover, then the net worth of the company, and it has to be tested on the basis of a test which includes relatability also. Second is material accounting policy information test. It comes out of the requirement of MCA notification which we have discussed. So it doesn't talks about specifically quantitative threshold. It is about making a judgment at your own that whether the information in notes to financial statement along with the policy information and Ind AS is relevant for the users of financial statement. So these two things are completely different and to be seen in a different manner
The
and
the
perspective.
only problem is it has come back to back, so people get
Yes,
a
yes.
little confused.
And the
Next, Priyanshu.
common word of material.
Okay, sir. So the third one is for Ankit ji. Is sitting fee paid to independent director shown under KMP? If yes, then how?
So so I think it's again a lot of deliberated issue. I'll show you something over the screen itself because we were time scarce. Here the sitting fees is not shown appropriately, right? Eventually, Ind AS 24 expects you to show your employee benefits into 5 category: short term, other long term, deferred, post employment, and other employee benefits. So, sorry, post-retirement benefits. So, so sitting fees is a short-term employee benefit, and the only way to show sitting fees is under the short-term employee benefit. Even if it is paid to an independent director, naturally, a sitting fee has to be paid to a non-executive director only. It's still there is a we have our India's facilitation transition group, right, which has already given an advisory in issue number 11, right, Kuldeep ji?
Correct, correct.
In
ITFG
issue number
committed.
11, you will find that all sitting fees is a part of short-term employee benefit, and and the only way to disclose this is an incorrect practice. The only way to disclose it under the five categories which Index 24 prescribes you to.
Correct.
Fourth one is for, are we expected to disclose cash and cash equivalent policy after the material accounting policy change, Kuldeep ji?
So, sir,
So,
the answer
so I think this was already deliberated. We
already
can skip
covered.
this.
Yes,
This
yes,
was
yes, yes,
deliberated. I think post this only this question must have come. We are
yes.
clear. We are clear. Either you give a footnote, either you give a footnote with statement of cash flow, or or then you have to write your cash and cash equivalent policy because you are using an indirect method for preparation
Correct.
of cash flow from operating activities.
All right. So next one is Ankit ji. When preparation of material accounting policy is management's responsibility, how is
I think we lost Priyanshu's voice.
Priyanshu, we lost your voice.
now it is coming? Can you hear me?
Yes,
Yes,
yes.
yes, yes. Yes.
The next one is when preparation of material accounting policy is management's responsibility, how is auditor responsible for it?
So auditor is in principle responsible. I discussed lot of cases of FRRB only pertaining to policy only. Auditor is
Yes.
in principle responsible even while we were having erstwhile companies at 1956. There was a section 211 which talks about auditor has to report to the extent of compliance with the accounting standard. All accounting policies are nothing but a compliance disclosure
Yes, yes.
compliance which we are making in compliance to the accounting standard. No auditor can be escaped if you don't if you're not agreeing to the policies of the management. It has to stand out in auditor's report, as simple as that, Priyachu.
Correct.
So Kuldeep ji, next one is for you. Please give us the
Sure.
example of indefinite life intangibles.
I think we have covered this also.
Yes, yes,
So,
yes.
yes, yes. But
I'll
just to
again show,
repeat,
maybe
Mhm.
I'll again show, right? Brand trademark is example of
yes,
indefinite
yes.
life intangible,
Goodwill,
right?
goodwill is also an example.
Goodwill is
Perpetual
also example
franchises
of.
are, yes, yes.
These are all intangibles. Even you might have more, but it has to be marketing related intangibles only, which will
Hmm,
have indefinite lives, not
hmm,
customer related intangibles.
hmm.
Okay. So the next one is, does bank deposits forms part of other financial assets under Ind AS 109? Will there
Yes, they,
be
yes,
Mhm.
they are other financial assets. Sorry, you
Okay.
can
Will
complete.
there be any impairment ECL of FDs and bank accounts?
Yes, there will be impairment testing which needs to be done. If there's a downgrade in, say, if you are holding a fixed deposit with State Bank of India, and there's a downgrade in the rating of State Bank of India, then the standard expects you to even prepare a ECL based on the credit risk or credit ratings which have gone down because of the credit rating going down of State Bank of India. Nothing, nobody is exempted to do that. And unfortunately, Priyanshu, 90% of the companies are not having a policy of impairment testing on their bank accounts and their fixed deposits.
Okay. Okay. Do we need to mention the policy for contract assets and contract liabilities, Kuldeep sir?
Kuldeep ji,
I think though we have already covered it, but again, there is a different opinion coming out on this. When you read it along with the revenue recognition policy, Yes, it is required to be disclosed because it is a specific requirement coming out of Ind AS 115. But you need to see it in line with the contract balances that you are having in your, balance sheet. For example, a contract asset can be unbilled revenues, and a contract liability can be a refund liability or right to return liability. So we need to see it in line with what amount of exposure we are having in our balance sheet. Like Ankit ji has said, there is a specific case coming out of FRRB's observation also. But again, you need to specifically mention what you are including under contracts as asset and liability rather than writing the definition which is given in Ind AS 115.
All right. So one is, can you show asset held for sales on face of balance sheet? A lot of companies are showing the same, but division to schedule 3 doesn't provide the same.
So when you look at division to schedule 3, yes, the format doesn't provide showing asset held for sale on face of financials. Majority of the companies show it in line of materiality because the auditors doesn't agree, and they want to come out and be very transparent, keeping it on face of the financials. However, when you do that, you are not complying to division to schedule 3 format. But when you deep dive into division to schedule 3 format, you will find that eventually it says if there are some assets and liabilities which are held for sale. So division to schedule 3 talks about liabilities held for sale, in which they say that you comply to the Ind AS requirements. And when you read Ind AS, so Ind AS says that the asset held for sale has to be disclosed separately. It is an option which the company is voluntarily exercising, even if they do not show it on the face of the balance sheet. Nothing goes wrong. Nothing goes wrong if even if it is shown as a part of footnote.
Okay, sir. So there is a last question now. What things should we take care while disclosing investment properties in compliance with Ind AS?
So I'll very quickly answer, right? Because I think we were disclosing this annexure. That is why I think this would have come. And I would say investment properties, once segregated from the normal property, plant,
Correct.
and equipment which you are disclosing. Two, if you are incurring any cost on these investment properties in terms of repairs and maintenance, you have to disclose this separately from the investment property which you are holding it for rental purpose,
Yes,
which is
yes, and vacant.
generating you revenue, and the repairs and maintenance and cost which you have incurred, which is not generating revenue for you. That separate disclosure is required, which is missing in this particular disclosure. So hopefully the only requirement which I would say, segregate this from PP, come out separately on it, and the cost has to be mentioned in the footnote with respect to whatever cost of repairs and maintenance we have done, for separately for vacant and separately for rented investment property.
Correct.
Kuldeep, anything you want to add into it?
I was just saying that the accounting policy information is also required to be disclosed. Only relevant part, because if it passes the essential condition test that the amount is material in case of investment property, then there is a specific disclosure requirement coming out of Ind AS 40, so it will automatically pass the secondary condition test. So from accounting policy information perspective, if it is of a significant amount to the company, then you need to mention the accounting policy information also.
All right, that was the last one, sir. So I would like to, on behalf of the Committee for Members in Practice of ICI, I would like to extend sincere gratitude to each one of you, for even for the audience, for joining this webinar today on the financial reporting dynamics, unrevealing challenges and solutions in accurate disclosures. So our esteemed speakers who have also shared in their valuable insight, shedding light on their the financial reporting thing and offering practical solutions to ensure accurate disclosure. Their expertise and dedication have enriched uh, today us today. And as we conclude this webinar, let us carry forward the knowledge and insights gained today into our respective endeavors. By embracing transparency, accountability, and best practices in financial reporting, we can foster trust, drive make informed decisions and propel our organization towards sustainable success. So once again, thank you for the members who are participating in this webinar and engagement with our uh, eminent speakers, and surely our leadership, President Sir, Vice President Sir, Chairman Sir Rohit Rubatia ji, and our Vice Chairman Sir. And we look forward for continuing the conversation and collaborating with you in future endeavors. Wishing you a continued success. Thank you so much, sir, for
Thank you.
the
Thank you,
webinar today.
Priyanshu. Bye.
Thank you.
Right. We call off.
Thank you.
Right.
Thank you.